In Holland, in the 1600s, market speculators pushed the price of a single black tulip bulb as high as $50,000 at today's value. Eventually, the market corrected itself, and tulip mania ended in the first capitalist market crash, plunging Holland into a bleak financial depression. How could the Dutch be so short-sighted as to value a tulip bulb at thousands of times its cost? That could never happen with today's information technology, right? Wrong. During the 1990s, .com stocks mimicked the progress of the renegade tulip. As the internet permeated our lives, tech stocks became hot properties that no investor wanted to pass up. Internet companies were overvalued, and some speculators had made millions. By March of 2000, the party was over. At year-end, the NASDAQ, which has a major concentration of tech stocks, fell 40% from its high of 5,470 on March 10, and the S&P fell 10%. In 2001, the NASDAQ fell another 39% as of September, and the S&P dropped another 21%. The inevitable downward slide seriously damaged investors who did not diversify their portfolios. In the mid-1990s, the Internet revolutionized the way we lived. Transactions, marketing, information gathering, and even staying in touch were modified and made easier as the Internet developed. Many companies that had anything to do with the Internet, from hardware and software development to content and service providers, were hot ticket items on the exchange. There was a flux of IPOs as new .com companies emerged and went public. Brand new types of goods and services were created to meet the demands of the new technology. These companies received exorbitant financial support by investors wanting to get in on the ground floor, oftentimes receiving far more money than they could ever hope to earn. In 1999, over $100 billion were invested in venture capital to finance startup companies. Nevertheless, the desire for wealth fueled investors to keep buying tech stocks, and as they did, the market kept rising. In addition, the flood of online trading firms made it cheap and easy for inexperienced investors to enter the market. People who had never invested before jumped into the market without the advice of professionals. Other investors used the internet to gather information rather than rely on financial advisors. Most investors wanted to be included in the stampede of .coms, and as long as they kept buying, the market kept going up, sometimes causing companies to be valued at more than they were worth. Despite the significant impact of the Internet, by the year 2000, the market became saturated with suppliers of technological goods and services. Consumers did not push their buying habits as quickly or completely as the .coms had hoped. The new technology companies were not making the income or sustaining the growth projected by the market, and competition to capture consumers' attention and wallets was fierce. Investors began abandoning the flooded tech market. By March of 2000, some analysts determined that the market could not withstand the growth overvaluation. The NASDAQ stretched to 5,048 on March 10th, but by September of 2001, it had fallen over 70%. The S&P mimicked the decline, although less severely. Some investors lost huge amounts of money. New investors that had entered the market through online trading firms had no guide to steer them through the unavoidable crash. Interestingly, other sectors of the market remained strong and profitable during the tech crash, and could have helped ease the devastation had they been part of the investors' portfolios. In the aftermath of the NASDAQ crash, financial advisors reminded clients to diversify their risks by adding variety to their portfolios. Mezro Financial is a Chicago-based company that offers a wide range of financial services to their clients for the past 65 years. Mezro Financial is a very diversified service organization with expertise in investment management and services, insurance, real estate, and investment banking. Alan Abramson is in the private client group at Mezro Financial.
The tech boom was a very difficult and exciting time at Mezro, and I think just basically in the industry. It was a time when the markets were moving up very dramatically. Clients in most part were making tremendous advancements in their portfolio, whether they were playing a very aggressive internet or technology posture or just being in the market. They were making quite a bit of money. However, there were a lot of competing factors that went into that, and it was very hard to keep people grounded. Whenever people have a lot of a good thing, they tend to lose sight of reality a little bit, and it was our job to try to keep them grounded during a very difficult time.
Portfolio management is the key to protecting your assets as an investor. A balanced portfolio protects the investor by diversifying risk. The underlying principle for risk and return is that investments with higher returns carry higher risk.
The basic principles of portfolio management are really through asset allocation. And that process is sitting down with a client and determining what their needs, goals, and objectives are, and taking the amount of investable money that they have and spreading them out amongst the different asset classes. So the three asset classes that you can use are cash, fixed income securities, and equities. The cash is there to provide some liquidity in case a client needs money so that they don't have to liquidate other investments, and also used as an opportunistic tool so that if things become particularly attractive, that they have money to then take advantage of it. The fixed income portion is there to provide stability and a steady yield or dividend flow from their investments, and the equities are designed over time to give them the added growth that most people need to outpace inflation.
Equity holdings are stocks. Stocks hold a higher risk because their returns fluctuate with the market. The potential for profit is great, but stock prices can go down as well as up, causing the investor to lose their initial investment.
There are two distinct types of investments when you're looking at equities. There's growth equity investments and there's value equity investments. And basically the determination between the two is what are you paying for in terms of their earnings ability. When you look at a growth stock, you're looking at a company that has consistently been able to grow at an above average pace, year after year after year, regardless of economic conditions. And for that consistent growth, people will pay a higher price for every dollar that they earn because they're somewhat comfortable that those earnings will continue into the future. A value investment is particularly a company that might not have growth going on today, that has a wonderful franchise, that has assets on the books which may be worth more than the stock is trading at this point. So there's inherently a little less risk in a value investment than a growth investment because you're paying a lower premium for each dollar of earnings.
Mutual funds can be a great alternative to stocks as equity holdings. They are portfolios of stocks that are bought and sold by a fund manager. Investors buy shares of the fund instead of buying shares of individual stocks. Risk diversification is inherent to mutual funds, as the investor's share of the fund is already diversified over a portfolio of stocks that the fund manager has picked.
The benefit of holding mutual funds in a balanced portfolio provides a couple of advantages. First off, you get a mutual fund manager that often comes with a great deal of experience and resources behind them, and most importantly, a track record that you could look to gauge what he might do in the future. But most importantly, I think, is that given a particular style, whether it's growth or value, international, or whatever your choice is, those mutual fund managers will diversify you amongst 50, 60, 70 stocks to achieve a particular objective.